What are the best mutual funds to invest in with the lowest expense ratio? An overview of mutual funds with the lowest expense ratio. Every person's life revolves around money in one way or another. Everyone is chasing after money and working as hard as they can to acquire it. But only a select handful are able to see the saving side of money. While the majority of individuals work hard to make a living, other people labor hard and make more money by cutting expenditures. You will learn more about mutual funds and their expense ratio from this video. To assist you in choosing which mutual fund to invest in, it will also include those with the lowest expense ratio. What exactly is a mutual fund? In layman's terms, a mutual fund is a type of organization that collects and pools money from various people/investors for the purpose of investing it in various financial assets. These investments can be made as a lump sum or as part of a systematic investment plan, also known as a SIP. Funds are managed by professional fund managers, ensuring that your money is in good hands and it will be invested skillfully for higher returns with minimum risks based on your investment objectives. Along with the previously mentioned benefit of professional fund managers managing the money, there are a few other advantages, such as liquidity and diversification. Mutual funds are of various types. The majorly known mutual funds are equity mutual funds, debt mutual funds, and hybrid mutual funds. Each of them has different features and naturally offers different rates of returns and different rates of risks as the assets are different. What is the expense ratio in mutual funds? Investment in mutual funds is expanding quickly. A large number of people have begun to invest money in it, and many new fund houses are opening to offer mutual funds with lower expense ratio. But what exactly is an expense ratio? One of the most significant advantages of investing in mutual funds is that they are managed by professionals who have extensive market knowledge. However, in order to provide this service, they charge a fee to investors because they enlist the assistance of highly skilled professionals and benefit from higher returns as a result. This charge by the fund houses is known as the expense ratio, also known as management expense, and it is typically between 1 to 3% of one's total investment. How does the expense ratio affect returns? We'll use an example to answer this question. Let's say there are two people, Ashok and Aparna. They both have 50,000 and want to invest it in mutual funds. Ashok invested in ABC Mutual Fund and Aparna invested in PQR Mutual Fund, which is amongst the least expense ratio mutual funds. After 1 year, it was found out that both of their mutual funds gave the same return of 10%. But, ABC Mutual Fund charged 2% as the expense ratio, and PQR Mutual Fund charged 1% as the expense ratio or the management expense. So, in this case, Aparna earned more than Ashok, as even though the gross returns were the same, the net returns of Aparna were higher due to a lower expense ratio. As a result, the expense ratio makes a significant difference in returns. In the above example, the difference in gains is only 1%. If someone invests 100, this may not appear to be much. But what if someone invests 100 crores? This 1% will make a significant difference in net returns. As a result, it is always recommended to invest in low expense ratio mutual funds, or, if possible, the mutual funds with the lowest expense ratio. Best mutual funds with the lowest expense ratio. There are numerous mutual funds available from various fund houses, but not all mutual funds outperform the market. Although some mutual funds may offer lower expense ratios, our goal should be to invest in a top-performing low expense ratio mutual fund. The following are some of India's top-performing low expense ratio mutual funds. Series 4 Kotak India Growth Fund, Direct Growth. Kotak Mahindra Mutual Fund has launched this scheme. This mutual fund has a fund size of 89.237 and an expense ratio of 0.34%. It invests in domestic equities 94.09% of the time, with 58.55% in large cap stocks, 8.69% in mid cap stocks, and 19.7% in small cap stocks. With a NOW of 20.768, it is appropriate for people who want to invest money for a minimum of 3 to 4 years and want higher returns with a moderate loss, because this mutual fund is highly risky. Quant Multi-Asset Growth Direct. Quant Mutual Fund has launched this scheme. This mutual fund has a fund size of 334.757 and an expense ratio of 0.56%. It invests in domestic equities 73.47% of the time, with 44.62% in large cap stocks, 5.16% in mid cap stocks, and 16.59% in small cap stocks. This fund also holds 8.96% of its assets in debt. The remaining 8.96% is invested entirely in government securities. With a NOW of 85.25, it is appropriate for investors seeking higher returns while being willing to accept moderate losses, as this mutual fund has a very high risk-o-meter. Direct Growth Tata Dynamic Bond. Tata Mutual Fund has launched this scheme. This fund is a dynamic bond mutual fund with a fund size of 144.19 and an expense ratio of 0.27%. 95.87% of the total amount is invested in debt, of which 80.64% is invested in government securities and 15.23% is invested in low-risk securities. As a debt fund, it is moderately risky and is appropriate for investors who want to invest for a longer period of time with lower risks. It has a NOW of 38.1082 and a 5-star CRISIL rank in the most recent quarter. Please keep in mind that the above-mentioned mutual funds may not be the best fit for everyone, because everyone's investment goals, risk tolerance, and investment time horizon differ. Thanks for watching the video. Like, share and subscribe.